Ladies and gentlemen, meet John. Well, metaphorically. You see, we've all heard tales of investors striking it rich, but today, we're charting a different course. The course of John's $2.7 million misadventure. You see, John took a risk. A big risk. He decided to short Apple. Yes, Apple. The titan of tech, the marvel of the market, well, you get the picture. Now, before you all start pitching your digital Rotten Tomatoes at John, let's roll back a little. John was no rookie. He had been playing the market for years, and with some commendable success. He was diligent in his research, analyzing market trends, keeping tabs on industrial fluctuations, and so forth. His research showed him several signs that pointed to a potential downturn for Apple. Increased competition, delayed product launches, and some choices at the executive level that made John, and some other investors, raise an eyebrow. At this point, some of you may wonder why John didn't just sell his Apple stocks. Well, John didn't just see an opportunity to exit, he saw an opportunity to profit. The allure of a high-risk, high-reward move. It's like a siren song for traders. So, John shorted Apple. For those unversed in the lingo, shorting a stock means betting against it. John was essentially wagering $2.7 million that Apple's stock would go down. Quite the gambit, wouldn't you say? But as we know, predictions, much like those dietary plans we make every new year, don't always pan out. Apple didn't fall. Instead, like a defiant balloon on a windy day, it went up and up and up. Much to John's, shall we say, chagrin? You see, with each rise in Apple's stock, John's position became more and more untenable. Until eventually, his $2.7 million investment had evaporated. An expensive lesson, no doubt. So, what did John do wrong? And more importantly, what can we learn from his misstep? John's first mistake was perhaps allowing his speculative thinking to overshadow solid, long-term market trends. Betting against a market leader, particularly one as resilient as Apple, is a gamble of epic proportions. His second error was not setting a stop-loss limit. It's important to know when to cut your losses. A stop-loss order would have automatically closed his position once the loss reached a predetermined level, preventing a total wipeout. And third, while high-risk positions can be profitable, they should only form a small part of a well-diversified portfolio. If John had diversified his investments, he wouldn't have put so many eggs in one potentially rotten basket. Now, John's tale isn't just a cautionary tale. It's a reminder. A reminder that investing isn't about quick wins, but calculated decisions, patience, and strategy. It's about knowing when to enter the market. But you see, that wasn't all to John's tale. No, there's more to learn here, and it's not just about what not to do. It's about understanding how the market operates, how companies like Apple function, and how a seasoned investor can still make a mistake of this magnitude. Let's dive deeper into why John shorted Apple. It wasn't simply the potential downturn or the competition. There were rumors of management issues, of intellectual property disputes, of slowing innovation. All classic signs of a potential decline. John saw these signals, coupled with a seemingly saturated smartphone market, and thought, here's an opportunity. In his mind, he was making a calculated risk, albeit a very bold one. Now, remember, the stock market isn't just about numbers and graphs. It's about companies and their stories, their products, their strategies. And Apple's story, as we know, was far from over. As Apple's stock price began to rise, John found himself in a tight spot. But instead of cutting his losses, he decided to hold on, perhaps hoping for a sudden turn of events, a reversal of his misfortune. But just like expecting a pizza to be fully cooked in 3 minutes, some hopes just don't align with reality. By the time John finally decided to close his position, his $2.7 million had dwindled to a fraction. An expensive lesson indeed, and one that John wouldn't forget anytime soon. So, what did John learn from this $2.7 million misstep? And more importantly, what can we learn from it? John learned quite painfully about the importance of having a diversified portfolio. A diversified portfolio, much like a balanced diet, offers protection. Just as you wouldn't only eat donuts for breakfast, lunch, and dinner, you shouldn't put all your money in one place, regardless of how appetizing it seems. He also learned about the importance of setting limits on losses. In the heat of the moment, it's easy to get carried away by hope, but having a set point to cut your losses can save you from a financial disaster. And finally, he learned about the dangers of betting against the trend, especially when it involves a strong market leader. There's a saying on Wall Street: the trend is your friend. And in this case, John learned the hard way that befriending the trend could have saved him a small fortune. Now, we might laugh or cringe at John's tale, but let's not forget the core lesson here. The stock market isn't a game of chance. It's a game of strategy, of calculated risks, of patience, and sometimes, it's about taking a step back and waiting for the right moment to act. So, as we wrap up our story, let's take a moment to thank John. His tale, as painful as it was, serves as a stark reminder for all of us. It's a reminder to always do our homework, to be patient, to diversify our investments, and to never, ever, forget about setting a stop-loss limit. In the grand theater of the stock market,